Hello everyone, and thank you for joining our webinar where we will be doing a wrap-up of the key topics and themes from the LBMA and LPPM Global Precious Metals Conference. Our presenters today are Suki Cooper, Precious Metals Analyst from Standard Chartered Bank, Jim Steele, Chief Precious Metals Analyst from HSBC, and Rhona O'Connell, Head of Market Analysis, EMEA and Asia at StoneX Group Incorporated. Now, before we begin, we'd like to remind you that you can submit your questions throughout the webinar using our Q&A function, which can be found in the control panel on your screen. If you have any questions using this tool, please email your question to ask@lbma.org.uk. And now with that, I will pass over to Rhona.
Thank you very much, Tanzin, and good afternoon, good morning to everybody who's here. Thank you very much for taking the time to listen to Suki and Jim reviewing the conference of last week. Suki and Jim sat through everything, which I think is a wonderfully stalwart performance. I'm not sure very many other people had the strength of will or the iron physique to be able to manage it, but they did it, and then they wrapped it up for those of us who've been sort of popping in and out because had meetings or whatever else it may have been. So we're bringing this to you today, particularly for those of you who weren't able to make it, so that they can give you a flavour of what was discussed, whether opinions changed, and the variety of views, both from the podium and on the sidelines of the conference. Now, one of the key areas to kick off with, as is pretty much always the case with LBMA and many other natural resources conferences, was the state of the economic background, although with gold being so important, geopolitics came in here as well. And as well as that, we had buzzwords developing like deglobalization and so forth. And silver was one of the elements that many people wanted to talk about. So we'll look at all of those. But just to set you sailing with just a little bit of background, as far as the economics were concerned, there was a debate right the way through the conference, which I'm sure nobody will be surprised about. Is the United States in a recession or not? What's going to happen to Europe? Are we heading into a global recession? Are we having to fight against conflicting sets of forces? For example, one speaker referred to how the inflationary forces in the United States are demand-driven, whereas in the European Union, it's much more a function of supply shocks given the proximity of Ukraine and supply chain dislocations, for example. I think probably one of the key elements determining the fact that the United States is not yet in a recession, although technically it is because of a couple of consecutive negative GDP numbers, or reduced GDP numbers, I should say, is a very strong state of the labour market. And to this effect, I think probably the key observation here came from Jim himself, when he pointed out in the wrap-up for one of his leading indicators of the state of the labour market is the fact that all three of his moronic sons, his term, not mine, are currently simultaneously in work, and that means the US labour market is tight indeed. On a slightly more downbeat note, Isabella Kaminska noted that the Bank of England has admitted recently that it had not seen the persistence of the tight labour force. Partially set against that was Peter Zoellner, who is the head of the banking department at the BIS, and he referred, among many things, to the rise of stagflation, and as I noted earlier on, the dichotomy between the States and Europe. He also pointed out that stagflation was a possibility from China, which accounted for roughly a quarter of global growth over the past 20 years. And in the macro and geopolitical risk panel, we heard Syed Amal, chief economist of Trafigura, talking of the macro fund strategies at the start of 22 being long dollar, long yields, and he was hinting that that strategy may not have much further to run. So that brings the question of the dollar into center stage. So Jim and Suki will be looking at all of these, but there's just one other element which came from a question from the floor. You can never talk about gold without at least one person wanting to talk about crypto. And we had a question from the floor about the symbiosis or lack of it between gold and cryptocurrencies. And this produced a glorious response from Adrian Ash, to the effect that being rare and free of government diktat is not a combination unique to just gold and Bitcoin. He could, for example, say the same thing about his cat, who is definitely rare because the vet's seen to that bit, and being a cat, he certainly doesn't do what he's told. So having set that background, I'm now going to hand you over to Jim and Suki. So I think perhaps the best place to kick off would be the economics and geopolitics and how gold intertwines with those. And over to you.
Well, thank you. Just to kick off, I mean, I want again to compliment Paul Fisher on his entree into, because he summed everything up very, very neatly, I thought, at the beginning, when he talked about the world facing the war in Europe and Ukraine, higher inflation, particularly in energy and food, and the challenges of the labor market. And all of these things have come together and are dictating what the gold price has done. I thought the first session in particular that Isabella talked about, the war economy, and it's that many people are facing now, much of the world to one degree or another was really very sobering reflection, and also the general idea about groupthink when it comes to how one views not just gold, but anything else. And so I thought all of that set the tone very well. I mean, certainly the head of the Bank of Portugal reminded us why not only a central bank would want to own gold, but why anybody would want to own gold, emphasizing the safe haven demand, the accumulation, of course, in times before, as well as constantly talking, certainly from the contribution made by BIS about debt levels and how that can feed through and impact the gold market as well as inflation. And then we began to get an idea about how monetary policy is impacting gold, and of course that being tighter and being one of the reasons that the gold market has not rallied so much.
Yeah, I think one of the consistent themes was that most people felt that the dollar was going to remain strong, perhaps for slightly different reasons, but that was likely to be a hurdle for the precious metals complex and much of the commodities. But I did particularly like the fact that Dr. Zollner shared with us one of the BIS models, and he discussed that in tightening cycles where we have a strong GDP or there's low job vacancies, that tends to be a period where we tend to see a soft economic landing or a shallow recession. And that's the scenario we're in at the moment. But if we have an environment where there's persistently high inflation or higher credit to debt ratio, that suggests that a recession could see a sharper landing. And it comes back to what Rhona introduced us to, that there are divided views. We could perhaps see a different outcome in the US, in the UK, across Europe. We may not see a global recession, but there certainly could be pockets of weakness. And going back to Bank of Portugal, they did mention that inflation obviously had been driven by a number of factors, but in the first instance, that shock had come from supply side disruptions from COVID. But then secondly, it had come from Russia's invasion of Ukraine, and inflation was very much a recurring theme. It was viewed differently, whether we would see inflation being counteracted by higher inflation. That was something that Isabella shared with us, that the cure for high inflation or high prices is high prices. But Kathleen Kelly later on shared with us that she felt that inflation would be tamed and that would come under control with the Fed's tightening cycle. So I think all eyes are on the Fed. Adrian again pointed out that gold really is correlated with real yields, and that is its key driver. But of course, it does have its political influence as well. And sometimes people want to be exposed to an asset that is free of political risk. And that was something that I believe it was I think it was in Bank of Portugal speech as well, that it wasn't, gold is still an essential element of an investment portfolio. It has attractive returns, and it's the only reserve asset that's free of political and credit risk. So I feel like the economic background that we started with covered a lot of the key factors that we are considering at the moment, but it also looked at inflation from many different perspectives. And we talked about the fact that initially, and I think it was Aline who mentioned this later on, who talked about inflation initially had come down because of deglobalization, but now we had a variety of other factors which might mean that inflation remains elevated for longer, and that can pull and push gold in different directions as well.
Yes, I think it was, correct me if I'm wrong, which I very possibly can be, I think it may have been Dr. Zollner as well, who, when I think it was a question from the floor, someone was asking the obvious question, which is that with inflationary expectations becoming more entrenched, why has the gold price not improved? And he pointed out it's a key element in his interpretation, was that it wasn't necessarily inflation of itself. It was what investors or potential investors expected the people who run the economies to do to head it off, or for that matter, how the markets might do it themselves. Because the old mantra always used to be it's the expectation of inflation that fuels investment, but now we've got it. It's a question of how it's going to be handled by the feel that I got from it.
I think that's absolutely right, and that's really key. And Andy Verity pointed this out when he, challenged the audience really that, why isn't gold higher? And I really came away from that session with that in my mind, because of course, the three of us are analysts, and that's what we ask ourselves every day. And given everything that's happened, and I find myself doing that when I discuss things with clients, and I talk about inflation, I talk about geopolitics, and then I talk about physical demand, and I find myself saying, well, then why is my forecast this, and why don't I think it's going to be $100, $200 higher? And that's what brought out, Rhona, what you just said, which really can't be overemphasized, which is that gold doesn't react, or gold investors don't, or at least the institutional investors, I should say, don't react so much to inflation, the latest inflation data. They react to the anticipated monetary response to that data. And right now it's tightening. And this was a theme right throughout this second session, and repeated throughout the conference, actually, was that the Fed is continuing to tighten, and that other central banks as well, that this is lending support to the dollar. And as a consequence, one can't expect maybe gold to do much better, or that it has done relatively well, particularly in non-dollar currencies, than what one might have thought otherwise. And I thought that session made that very clear, and also discussed the politicization of the gold market and how it reacts to these geopolitical issues a little stronger in non-dollar terms than you would see by just looking at the dollar price.
Indeed, yes, and that actually leads us beautifully, Jim. Thank you. That leads us into our next sort of segment, if you like, which is polarization and deglobalization. We've already mentioned at the top of the show, as it were. So there was quite a lot of conversation, again, both in the sessions and on the sidelines, about economic tensions and geopolitical tensions, and how both of those are having something of a polarizing effect in the markets. And that segues into deglobalization, because in any time of stress, there tends to be a degree of self-preservation. And that's led to some problems with liquidity. And Dr. Zerda said that we were entering we were already in an era of scarcity, not just in terms of goods or services, but also in terms of investment. So again, this feeds into conversations about gold and latterly silver, but we'll come back to that. I think silver deserves a little bit of time of its own. But I was wondering how you and Jim and Suki interpreted what was going on through the conference in terms of things like tension and polarization and deglobalization, and how the markets certainly as far as gold is concerned, were responding to those different, slightly conflicting forces.
Well, I suspect that the gold market would be lower if we weren't in this period of deglobalization. If you look at, globalization is not gold's friend. Periods when the world is fragmented, one thinks of the cold, moving away from the conference itself for just a minute, but thinking about the Cold War when gold did quite well, it virtually collapsed in the wake of the end of the Cold War throughout the 1990s and into the earlier part of this century. And then with globalization, it tended to remain weak, but has rebounded as the world has become more fractured, and geopolitics is now. I wouldn't say it was the primary driver of gold, but you tend to look at the same 7 or 10 things year after year, And it's really the weighting of each of these things that impacts the gold price. And I think geopolitics has moved up the scale without doubt. And this is also reflected in other commodity prices too.
I think the fact that deglobalization was mentioned consistently by different speakers in different topics just shows how important it is at the moment, and the impact that it's likely to have on the precious metals market, whether indirectly through elevated inflation or whether directly through increasing the cost of production. So Dr. Zollner did mention that we're now seeing longer supply chains as a result of deglobalization, and that has led to inflation perhaps remaining elevated for a much longer period of time. But that fact that core inflation had risen in the US means that we're perhaps likely to peak, more likely to be closer to peak inflation, at least in the US. But we also heard from Aline talking about the fact that we're seeing a reversing in the cheap supply of goods from China on the back of deglobalization, that there was a supply chain crunch as well. And again, she reiterated that it contributed to inflation. But I think one of the interesting takeaways was a conversation or a dialogue that we saw between Saad and Adrian in the macro session, where they talked about new blocks that were forming. And Saad talked about the fact that we have an immovable object in terms of the fundamentals were tight across a number of commodities. We'd seen underinvestment, and he picked on energy in particular between 2008 and 2020 in the energy sector, and that was feeding through into some supply tightness. And Kathleen talked about, again, we were seeing it in the energy space, but she thought next would be industrial metals. And then after that, we would see that same sort of underinvestment impacting the underlying metals in future years. But Saad talked about the immovable object, but the unstoppable force being the macro headwinds, and that had created this disconnect between spot prices being either flat or falling, but premiums being elevated because of that physical market tightness. But when they talked about these new blocks forming, we're perhaps seeing after Russia's invasion of Ukraine, we didn't necessarily see that tightness in the palladium market persist throughout the year because we were seeing trade flows in different directions. So I think it's manifested itself in different ways for the precious metals complex, partially in inflation, partially in the higher cost of production, but largely we're seeing lead times extended in terms of investment as well.
Yes, and as these supply chains get rejiggered, there's always going to be some near-term friction. And I think we can probably all agree that the gold market would be higher facing all of those things, except that again, that session came back to this persistent dollar strength, which is effectively masked what would have been higher gold prices.
Yes, indeed. And there certainly among the bullish dollar stories that I was hearing, I'm sure everybody did, was the fact that we have an independently weak European side, and China obviously has got problems of its own. And although this is not a China-centric call that we're holding, the fact that we've just had the Chinese quinquennial conference and the reinstallation of the president for his third term, and the implication is that the economic and political policies are not actually going to change very much, that's also potentially playing up to dollar strength. So there are arguments for and against, and we certainly heard plenty of them. In terms of what Suki was just talking about, long lead times, one of the comments that certainly I heard a couple of times was the lack of investment on the mining side, and how this could potentially give us another independent supply constraint to maybe 2 or 3 years hence, because of the length of time it does take typically from discovery to actually producing your first refined metal pour. It doesn't have to be gold, could be any of them, depending on the depth and the country that you're working in, of course. The lead time can be anything up to 10 years. Which is a longer time horizon than a lot of professional investors are looking at, maybe slightly different in retail. But it looks as if there is potential problems there waiting over the horizon for us. But more immediately, as you both just mentioned, we've had supply chain issues, and they're going to persist. And this brings us on to one presentation, which I certainly found fascinating, and I'd really like to hear what you two have got to say about it. Which was the session right towards the end that Nick Frappel led, with individual presentations from Mark Woolley and Terry Hanlon talking about logistics in Mark's case and the coinage sector and private investment in Terry's. Then they were joined by Sunil Kashyap and Amal Singh to round it out. And I personally thought that was a fascinating session. I'd love to know what you two took away from it.
I thoroughly enjoyed that session as well. And I think one of the reasons I enjoyed it was because I think it's the first time we've had an opportunity to really hear from a logistics company and hear firsthand what the challenges they were facing, but also to be able to quantify just how large these increases were in terms of freight costs and how much longer some of these lead times were. I think we all knew anecdotally that yes, there are longer lead times, and yes, the cost of shipping had risen, but just to see some of the challenges that they were contending with was really fascinating. And I think it was a testament to the market that metal was being able to be delivered. Maybe it took a little bit longer, maybe it was a slightly different route. And Mark shared with us that the industry was able to deliver as long as you're prepared to pay enough. There's always space on that plane. And he showed us some fantastic charts, one with global freight costs rising 5 times in the space of less than a year. And the fact that it now had become cheaper to fly silver rather than ship it by sea, I think was fascinating when you look at just how much those costs had risen. I think some of the key takeaways for me from that session was just the way the metal had flowed firstly to the US. And he talked about the Brink's inventories and COMEX rising to 550 tons, but also how the flow had changed as well. Initially in 2021, we saw a recovery in flow going back to India. In 2022, we've seen a recovery of flow back to China. But he shared with us the lead times in terms of those, how difficult it was to obtain vessels, and that previously 73% of vessels were on time, and now it's closer to 35 to 40%, and it was 3.5 to 4 times more costly. So I think it was fascinating to see what this tightness in the market was, and to be able to attribute what those pressure points were, and just how it's manifested itself in higher premiums. And Sunil and Amar shared with us how consumers were prepared to pay the higher price. And Sunil shared some fascinating facts, in that previously you may have expected your silver to have been delivered within a few weeks at the cost of 5 cents. Now you're prepared to pay 25 cents, but you'd have it shipped within 2 days as opposed to 4 weeks. But you needed that clarity in terms of demand, because you didn't know what demand was going to be doing in 1 week, 2 weeks, 3 weeks. So to be able to have the metal delivered more reliably, consumers were prepared to pay for that higher cost.
Yeah, and I really think that crystallized a lot of, from the previous session, from the investment panel previously that John Reed had led, because it helped to make much more clear the difference between retail demand and institutional demand. It showed this enormous demand for silver, for example, into India, the lack of stuff coming out of China, and this really and the enormous demand for coins and bars. It sort of reflects on that. What he didn't talk about coins specifically, but it sort of reflects on why these premiums, particularly for silver coins, $13 or so. I'm not quoting that today, but it has been passed, so 50% more than the price of the silver. Never seen that before. Never seen so much going by air. Never seen so much going into India. And what does this all mean? This means that the retail, the underlying demand for silver and for gold as well. I mean, let's not talk, the imports into China and India have also been very strong recently for gold, and this shows this very, very strong retail demand, which is also reflected in a coin and small bar demand in the OECD as well, and would have probably pushed prices higher. Terry Hanlon talked about the shortage of blanks that the mints can't make. What a marvelous position to be in, not to be able to sell something because you can't make it quick enough, not because someone doesn't want it. But that this is all showing this enormous underground demand, which again has not translated itself into the price for gold or for silver, as much because of the ETF liquidation. And this is very clear, this cleavage between Wall Street and Main Street, and you know, it continues. But at least it highlighted things, and it sort of reflects the dollar strength. And I was also interested that the ideas of the panel also said there'd be no Plaza Accord, so no likely restraint on how far the dollar could go.
You're right, it was brought up on more than one occasion, not just the physical session that we had at the end that looked at global flows, but it was brought up in the investor session that John Reed expertly chaired as well. And both Amir and Darren talked about the fact that even though we've had these huge ETF outflows, that the physical market has been able to absorb most of that metal. Yeah. And they both pointed to India and China, as you say. So yes, we had a session dedicated to it, but it was a recurring theme that from the investment community that they were keeping an eye on as well. And I think it was interesting that the market has been able to absorb this metal, but the price hasn't been able to trend higher. But it just shows that there are different dynamics in play.
Yeah. I actually take I like being a contrarian. I think most analysts do. If you
and who's to say where the gold would be if this retail demand wasn't there?
Indeed,
you know, and you've got this institutional selling.
Absolutely right. If you set aside the exchange traded products for a second and just look at the inventory falls particularly in silver from the LBMA and the CME. I tend to think of it the other way. I don't think of it so much as the metals coming out and the markets absorbing it. I think the metal from those two sources, at any rate, not the exchange traded funds, is actually coming out because the market's demanding it. And it's got to come from somewhere, and it's currently not, to any great extent, coming from China, which, is, as you say, was an issue which came up on more than one occasion.
I like your perspective, Rhona. It's funny, I think about the PGMs in that context, but not gold and silver. So I like that you pointed that out.
I always try and look at something that's slightly different. I like disagreeing with people. It's much more fun than running with the herd, which is actually...
No groupthink from you, Rhona.
No groupthink from me. I was actually heartily depressed that my gold price forecast, we're going to come back to the price forecast in a second, was pretty much bang on the mean after the end of the conference. I didn't like that at all. But there we are. We've already touched on silver, obviously. Silver seemed to be the one that an awful lot of people wanted to talk about. And Jim and Suki have already talked about the fact that there's been a very, very strong pull in silver. And one of the things which is quite interesting, and coming back to the mining investment side and also the cost of energy, is that one of the areas which came up on several occasions, and there was a silver market roundtable, which was a reasonably successful one. There was a good flow of conversation with some really deep domain experts on that table, including the likes of John Butler and Adrian and Neil Meader from Metal Focus, was the fact that we've got an energy crunch in Europe in particular, and that is already threatening some of the lead zinc smelters in Europe and potentially also copper. And of course, over 60% of silver's refined production comes from lead zinc or copper or gold byproduct, or for that matter, industrial scrap. So we may find that there's a point at some point in the next year to 18 months or so where there's going to be something of a hiatus in silver supply because those smelters in the base metal side are going to be under pressure. And that's something which quite a few people pointed to. Whether that would affect the spot price or whether it would affect the forwards is a slightly different matter. But the one other point that I tend to think of here is the level of the professional market participation in silver. If you compare just the COMEX turnover against mine production as a multiple of mine production, then COMEX turnover in silver, that multiple is twice the multiple that is in gold. It's around about 150 times or so at the moment. So that goes part of the way to explaining why the spot price isn't doing very much, because that goes back to what you've been saying about professional investor attitudes. I don't know whether there's anything that you would like to add as far as silver was concerned, because it was certainly a fairly lively debate.
I would just throw in quickly about with the refining. You know, it was a very brief comment, but you know the difference between production of 4.9s and 3.95s. And the quality of the they're both high grade. But please don't anybody think that I'm implying that one form of silver is worse than the other. But there does tend for some industrial processes to be more demand for the 4 nines, and that could go back to Rhona, what you were saying about electricity shortages and energy shortages impacting refining in Europe.
It's certainly a risk that people are thinking about, and I wouldn't be at all surprised if Brinks has got their eyes very closely on that as well for future shipping programs and plans. Right, so we will come to the polls very shortly, and I've been asked to cue this up so that Harry knows that it's coming, and there it is, as if by magic. My goodness, this was a bullish conference as far as silver was concerned. I had the impression from I'd love to know what Jim and Suki think about this, but my impression was that when we were talking to each other, the general tone was a little bit downbeat about the outlook for the metals, and that goes back in particular, obviously, to the outlook for the dollar, where we have mixed opinions. But for a downbeat conference to come up with an 11% nominal price gain in gold over the course of the next 12 months, I thought that was actually pretty bullish, given the general feeling that I picked up. I don't know whether you felt the same.
No, I agree. I mean, look at the forecast, 1830. I mean, that's it's not $200 from where we are now, but it's what, 170 or so, and 10% higher than the prevailing price at when the conference was there. My kind of impression on the gold and the dollar was that, and I'm not saying this is HSBC's view on the dollar, but that the dollar was expected to stay strong, but only up to a point in 2023, and perhaps that wasn't extending through to the entire year, and that might have been where gold could have had some breathing room to rally, or at least that the dollar, even if it may just stay strong, but not gain further, and that might allow gold some latitude to the upside. But the other comment is that's a really bullish silver number. $28. That's only $2 below where it, or less than $2 below when the speculative run up took it during GameStop, during Reddit.
Yeah. It's also, sorry, Suki, carry on, please.
So I do think there was a disconnect between the optimism that's reflected in the poll versus a lot of the conversations that were had. But it also took me back to a comment that Adrian made in one of the opening sessions, that he was asked, why isn't gold higher? And then Jim, you've referred to this as well. It's the way that perhaps we are seeing the world rather than seeing what the blind spots are or what is there in front of us. So maybe part of it is being reflected in that the underlying market is very strong. So we feel like the physical market might prevail and offset some of the weakness on the investment side. But also that I think gold, and we had this coming through in the economic session, that gold is being pushed and pulled by so many different drivers at the moment, whether you fully focus on inflation and therefore you believe gold should be higher, or whether you're more so focused on the rate tightening cycle, but you think the Fed will stop or pause or pivot in the first quarter. And I think Amir mentioned this in terms of what the pivot might mean for the gold market. And he expressed that he would want to be long gold, but not in dollar terms. But if the dollar, like you say, Jim, shows that it's pausing or that starts to weakening, then you'd be interested in looking at gold in dollar terms again. And even Darren mentioned this in the investor session, that he would be interested in establishing a long position, because Kathleen took the contrarian view and said she could see gold falling to 1,300. And that would be perhaps a buying opportunity. But what I liked, especially on silver, was that even though it was discussed a lot, was that there wasn't a consistent view. Not everyone thought silver was going to move higher, although it is being reflected here in terms of, I think, some of the longer term themes that were talked about through the conference for both platinum and silver, that there's some very bullish themes that are unfolding for both of those metals. But whether we see them playing out in the next year, I think will depend on how deep a recession is, if we see a recession materializing in the US or across the UK or Europe.
And just to touch on really quickly for for a metal that jumped so high to all-time highs in March, and then dropped like by 50% at one point. The palladium forecast is almost unchanged. So all of that volatility, all of that excitement, all of that concern, and then retreat seems to have bled out of palladium. There's not a lot of talking about it. Everybody was relatively neutral, and it was the platinum that got the attention when it came to PGMs, except for ruthenium, of course. But you know, that's a sort of minor metal relatively, and you know, and that tended to concentrate on the hydro issue and all of the new applications that we may see for platinum that will not necessarily, and to a large degree, will not benefit the palladium.
No, indeed, and obviously the big story there is the electrification of vehicle fleet, and it's a 10-15 year view. But as we were saying earlier, the lead time to bring a mine on stream, if a mining company will be looking at a 10-year time horizon anyway.
I was just thinking that Sunil also shared with us some insights as to why silver demand was so strong in India. He talked about that imports were currently closing in on 8,000 tons, and we're probably going to finish the year at 10,000 tons when normally we're around about 5,000 to 6,000 tons. And he did mention that there'd been a good crop this year, and there was a short-term incentive that consumers were looking to pivot into silver. But I think some of these dynamics are short-term positives, because Kathleen raised the concerns that Diwali is now behind us. But I think the longer-term trends will be dependent on whether we see a dip in recession impacting industrial demand more so.
Yeah, indeed. And there's another element in the Indian silver market, whereby when the government changed or raised, I should say, the import tariffs on gold about 2-3 months ago, they did something with silver doré, but they left silver bullion alone. And I asked our Dubai office about this yesterday, and whether they think there's going to be any change. They said they couldn't see anything on the horizon. So that may have something to do with it as well.
The tax issue sort of penalizes gold in India more than the silver.
Yeah.
Just a very general comment about is that I did notice that there was relatively little discussion about jewelry specifically. We talked a lot about retail demand for gold, and jewelry is wrapped up in that. But I was interested that there was much more emphasis on bars and coins and on institutional trading and the ETFs and the OTC market, and less on the jewelry market. I thought that was interesting.
If the conference had been in Asia, that might have been the other way around, do you think? Because
Indeed.
we had a low Asian complement for obvious reasons. Because jewelry in Europe and North America is adornment rather than investment. So if we'd been 3,000 or 4,000 miles further to the east, that might have been a different balance.
Very good point.
Suki, Jim, that was wonderful. Thank you so much, and wonderful insights and understanding as always from you guys. Tamsin, do we have any questions? I've got a couple, but if there's anything from the audience, as it were, we should give them precedence.
Yes, so I'd suggest if you start with your questions, and in the meantime, to everyone watching, if you do want to submit any questions, you can do so using the Q&A button on the toolbar on your Zoom screen. But Rhona, if you want to kick off.
Sure, will do. One for each of you. I don't know whether it's going to be a very easy question to answer, so please forgive me. It's an easy one for me to ask. Was there any one session that stood out for you as being either the most interesting or perhaps the most revealing?
I truly enjoyed the logistics session. I thought Mr. Tate deservedly, and I thought all the speakers were very good. I actually could not think of a single speaker that did not do a very good job, with the exception of myself on the wrap up. I thought Suki did a splendid job and carried both of us. But I thought Mr. Tate deservedly won the gold coin. I thought the explanation, particularly from someone that worked in that business when I was young, that explanation between air and freight, between sea freight and air freight, between the lag time shipping, port congestion, the difficulty with getting crews. I mean, this was the sort of thing that you go to the LBMA to hear. You're not going to hear it on CNBC or even Bloomberg. No,
indeed, very good point. Suki?
You're right. It's an easy question to ask, a difficult one to answer. I really enjoyed each of the sessions, and I took away something new from each of the sessions, which is something as an analyst you absolutely want to do when you come to the LBMA conference, and the conference delivered. I think I agree with Jim in terms of the logistics sessions and flow sessions. That was something that was an additional insight that you won't get from reading a textbook or reading reports, and to be able to just have a better feel for what some of the challenges the industry faced. I enjoyed Terry sharing with us the sort of premiums that they were seeing in the market, and Amar said that would be a fantastic business for us all to see 60% premiums, but it doesn't happen across the supply chain. In the investor session, I thought the discussion led by John Reed was so in-depth, and he addressed so many different topics, each of the ones that I had been thinking about myself, and we had a panel that didn't agree with each other and provided a different perspective. So I enjoyed the fact that not everyone was positive on the same thing, or people had a different view on inflation, or a different perspective on what China's reopening might mean for the commodities market. And I also enjoyed day 2, where Peter Boyd kicked off with his session on asking us questions on what we felt and what our concerns around climate and carbon emissions, and he polled the audience. So I felt for every single session there was something that was thought-provoking, but even the PGM session, I enjoyed the fact that I learned something new from a chemistry angle that I wouldn't normally, as an analyst, look at. So there was something for me in every single one of those sessions. So I'm going to give you not a very good analyst answer.
That's a perfect analyst answer. I have to say, I have unhappy memories of organic chemistry at in my first year at university. I could not do it, and I saw those equations, so I thought, no, this is horrible. But it was a fascinating session, I thought, even though it's not going to make much difference to any of our supply-demand balances.
Right.
It's nice to know that the work's going on in the background for new products and so on. Thank you.
And Mr. Clark's comment, showing the investment applications for the PGMs. Yes. I came away. I came away very, very happy that sort of thing was being done, frankly, and that had a lot of applications. And I think, just to echo what Suki said, I think many of the panels had a very nice complement of people, say like Darren Botha, who were in the trenches. John Reed, looking at it from a more maybe a strategist point of view, to people like Isabella, who are, outside of our business, but nonetheless very au fait with macroeconomic and geopolitical issues. I mean, and this balance of these 3 types, and the physical market, of course, with people like from the mints and the whole, whoever put all this together, compliments to the LBMA, because none of the sessions were overweighted in one area or another.
And I agree with you, Jim. Mark Woolley was a worthy winner. He not only delivered new information, but he delivered it in a very interesting and engaging manner as well. Yes,
it was stimulating and it flowed, didn't it? It made you want to sit up and listen.
Did I get the name of the winner right? Maybe I said the wrong name, but I think everybody knows who I meant.
Yeah, we know it was Mark Woolley. Yes, indeed. Gold-silver ratio springs to mind. In fact, Jim, you mentioned it earlier before we came on air, as it were. So, would either of you like to address that? Just to give you a little bit of background, I did some work on silver before the conference for something else, and I got into the numbers, and it was 1 in Egyptian times and in biblical times. It was 15 for a long time when we had the gold standard and the silver standards. If you take it from Bretton Woods, from the closure of the gold window in 71 up to today, it comes in a smidge below 60. And if we do achieve the LBMA conference forecast polls for gold and silver next year, that would be a ratio of 65. Do you think that's possible? I'm not sure it is.
Well, just to complement what your historical analysis there, Rhona, we did something rather similar, and we found that from Greco-Romano times up until the Middle Ages, the ratio was a steady 10-to-1, which of course dovetails your 1 in Egypt and then 10-to-1, and we found that and the 15-to-1 rather, and we found that the big change came with the discovery, or not the discovery, because someone was living there already, but with the European settlement of the Americas, and what the Spanish really brought back from the New World wasn't so much gold as silver.
That's right.
And it altered this gold-silver ratio forever.
Absolutely. It also gave rise to the silver standard because it meant we had a good source of supply.
Yeah, and America, the United States, was on a bimetallic standard when much of the rest of the world was on a gold standard only, and China on a silver standard. But 60, as positive as I am personally on the silver price, 65 strikes me as a little too low. But I do think that what are we now, 80 odd something?
84, 85, yeah.
Yeah, I do think that that's too high, and that I would look for a relative strength on the silver price, not just because of coin and bar demand, small bar demand, I should emphasize, but also solar power, and any recovery, any further recovery in electronics. About half of silver goes to industry, but the majority of that goes to electronics. Yeah. And so as the chip crisis is remedied and as electronics gets back up again, you'll look for more silver.
Absolutely. Suki?
I think it was Kathleen who mentioned that she would want to be longer or short the gold silver ratio, and she also talked about gold possibly falling to 1300. And she said the target from current levels, perhaps she would aim for something around 70. And John Reed pointed out the long run average had been closer to 60, maybe closer to 50 when we look at it from tradable markets from perhaps the 1970s. So even that was not bringing it back down in line with the historical norm. But if in that instance you're looking at gold prices at 1300, then that suggests that silver prices have remained unchanged over that duration. So I think it's unlikely we would see a market where silver does not fall as rapidly if gold has fallen that sharply. Having said that, silver has really followed in the footsteps of copper this year rather than following in the footsteps of gold. And we've seen a much steeper decline across the base metals, and silver has been exposed to that, perhaps with concerns around the industrial demand and concerns around recession risk. But I was also thinking about some of the metals focus numbers, and back to one of the comments that you made, Jim, at the wrap up, that retail demand does matter. And even though we've seen ETF inflows being quite sizable, the metals focus data shows that in some of the peak years, bar coin demand has made it close to up to, I think back in 2015, up to almost 30% of silver's end consumption. So the bar and coin demand that we're seeing is incredibly important. But I think the way markets are reacting at the moment does show that gold has both its commodity appeal and both of its investment appeal as well, and from a currency perspective. So I think in terms of the gold silver ratio, I think it was something that was very much more popular a few years ago, but I think it may not be in vogue just yet. But perhaps over the long run, we could see silver starting to outperform.
Yeah, certainly if we see sorry, I can't speak, turns and trends for sure. It always seems to capture the imagination, doesn't it? Right, we have one from the floor or from the audience, which I think will probably wrap us up unless something comes in. And it's a good one, it's a nice one on which to finish. And it says, when do you think ETF outflows will stop and we will see ETF outflows inflows again? And what could be the trigger?
So
I think the beginning, yeah, this is for gold specific. Oh, please, on you go.
It doesn't specify, so the choice is yours.
For the gold market, we're assuming that we continue to see outflows for the remainder of this year, but we think we'll see a turning point into next year. So in our balance, we have a small net inflow for the full year. for 2023, but we still have a net outflow for all 4 precious metals for 2022. And we think the turning point is more likely to come when we see the Fed pivoting. So I think at the moment, markets are focused very much on the fact that dollar strength is likely to persist for the next few months. But I think gold is torn and is being pulled and pushed in different directions, whether you are focused on the physical markets. I don't think we're necessarily seeing a rotation out of ETFs and into bars and coins. I think it is a different type of investor who's interested in the retail market versus holding the ETFs. But at least in gold, we see net inflows emerging next year. For silver, we think we're going to see net outflows starting to slow down, perhaps towards the middle of next year. But we think the pace of outflows will certainly slow down, not comparable to the pace that we're seeing in 2022, but we might still see it as a drag. Having said that, I'd quickly add that we have silver in a net deficit for both this year and next year, even with those ETF outflows.
Similar to Suki, net outflows, but the bleed, if you like, is lessening. There's a torquay on the wound, and we're noticing less virulent liquidation and on occasion accumulation in the gold and the silver ETFs. I think that as we get through the first quarter, similar to Suki's reasoning, I wouldn't maybe define it quite as a pivot, but with the end of the Fed tightening cycle. Even if that doesn't then prompt a reduction, say towards the end of the first quarter, and as you're going into the second, then I think the ETFs will be able to stabilize and rebuild more in the second half of the year when the geopolitical issues and other things and possibly less, the market won't be second guessing itself with Fed increases after a certain point in the cycle, and that will allow both gold and silver ETFs to rebuild. But yes, negative for the rest of this year into at least the first quarter of next year, and then a rebuild in the second half.
And when they do start rebuilding, it's perfectly possible that would underscore a change in trend in the price, because since we don't have full transparency, because although all the funds report, not every single fund gets picked up by the press. So the Bloomberg or the Reuters daily reports, for example, but they've got the vast majority of them. And there's been more than one occasion when the ETFs have been price makers rather than price takers, and certainly in terms of changing in trend, that tends to work as a virtuous or a vicious circle. Right.
Yes, the R squared is pretty strong between ETF flows and the gold price.
Yeah,
but not with the silver. We didn't see a strong correlation there. But the silver ETF market is smaller.
That's where you get the copper influence as well, as Suki was saying. Silver deciding it's a base metal for half the year and a precious metal for the other half. Let's say I'm putting words into your mouth, but what your reference to the industrial side of the equation. We have no more questions come through. Thank you both so much for that. That was fascinating. Thoroughly enjoyed it. And I hope the audience did too. I'm sure that if anybody has any further questions, we will be only too happy to answer them. So just go through to Tamsin, and Tamsin or Harry will be able to tell you how to do that.
Thank you, Rhona. So first off, I'd just like to remind everyone of our upcoming events with the LBMA. In November, we have a training course, an introduction to Loco London on the 17th, and how to use Loco London on the 18th. In December, we've got our annual seminar and dinner on the 7th. On the 2nd of March, we've got our annual party. And on the 12th to 15th of March, we've got the Assaying and Refining Conference. If you did have any further questions, and you weren't able to ask it during this call, please do email them to ask@lbma.org.uk. and we will come back to you with those answers. If you would like to watch this on replay or any of our other webinars, we do also have all of these available on our website at lbma.org.uk/webinars. So thank you for joining us today, and please do take a moment to fill in the feedback form, and have a lovely day. Thank you.